Yes, I know. The title of this video sounds like a clickbait. And it sounds suspiciously close to what you see in a late night infomercial or random YouTube ads. But hear me out because it's also completely true. In this video, I want to show you from my personal perspective one of the simplest yet the best way to double your money. That is, if you're willing to be focused, let time work for you, and have patience. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. If you read any personal finance books lately, what I'm going to share with you isn't new information, and it isn't rocket science. But I do want to caution you that this is not a get-rich-quick scheme. What I'm going to share with you in this video will double your money. However, it will require a good understanding of the market fundamentals, conviction to ignore the noise, and most importantly, as I stated earlier, patience. This channel isn't called Financial Tortoise for no reason. You can build wealth, but I believe one of the best ways to do it is to do it slowly. But first, let's start out with what I view as several misconstrued views of the stock market. You yourself might be well informed about the fundamentals of the market. However, to be honest, if you are, you're actually in the minority. The majority of people out there don't know the fundamentals of investing or the stock market in general. That is the primary reason I wanted to make this video, because I believe that is where it starts. Knowing the fundamentals of the market is the key to being able to invest large sums of your money over time with the confidence that you're not doing something to jeopardize your financial well-being. So what are some misconstrued views of the market? One group are those that believe the stock market is just a big roulette wheel. They believe that the market is rigged and the Wall Street is out to get you. So it's best not to play at all. Keep your money in a safe, secure savings account. Or better yet, in a shoebox hidden under your bed. The second group of investors are the ignorant investors. They just do what the so-called professionals tell them to do. When they started their job, they just check some boxes for their 401k and haven't looked back. When a smart-sounding investment professional tells them to buy into the latest hot stock, this group asks, where do I send the money? The third group of people are extreme individual stock pickers. They don't believe in mutual funds or index funds. They do their own research to pick winning individual stocks. They have an array of stocks in their portfolio. Google, Tesla, Apple, gold, diamond, corn, rabbitfoot, you name it. They have a lot of reasons why they believe their pick will make them millions in the future. All these approaches make sense. I've been in all these groups at least at one point in my life. But the sad fact is that all these approaches are wrong when it comes to effectively making money in the market. Each represent a lack of knowledge or a false belief of knowledge about the market. Therefore, let's step back and get a good understanding of the nature of the market so we can have the confidence to invest knowing we aren't doing anything foolish. Yes, investing in the market isn't the only way to secure our financial future. There are tons of other ways to do it. Investing in real estate, starting a business, or winning the lottery. However, from my personal experience and what research says, for the majority of people, it is one of the single most effective ways to grow and double our money in the long run, especially with very little effort on our part. So what is the stock market? Or better yet, what is a stock? A stock is simply a slice of a company that you own. When you own a share of a stock, you have the right to attend a company shareholder meeting, vote on company's decision, and importantly, you have the right to a share of any future earnings that company makes. The share of earnings is most commonly called dividend. And as a partial owner of the company, you reap the financial benefit of the company's success. The success formed by all the hardworking individuals within the company, creating great products, serving their customers, and making great profits. Yes, is there volatility with owning a stock? Of course. And this is because there's so much money to be made in the stock market that everyone has an opinion of how a company will perform in the near future. And these opinions often drive the short-term ups and downs of a single stock, or even a group of stocks. However, the true value of the stock is based on the fundamentals of the company itself, its product, service, and most importantly, profit. Therefore, in the long run, all the speculation and volatility are just background noise. The value of the stock will go up as the underlying company's profit goes up. And for a company with strong fundamentals, profit will go up because of the natural ingenuity of hardworking individuals. They'll continue to find efficiencies, create better products, and in the long run, advance the market's ability to serve people. Could we enter a time when the market completely crashes and we're no longer advancing as a civilization? Of course, but based on the fact that we're still flying around in planes, and Amazon is still delivering boxes of goods to our door on a daily basis, I like to believe that we have a long way to go before we start worrying about the world ending. Alright, you might be thinking at this point, I get it, Tay. Buying stock sounds like a great strategy to double my money and grow my wealth. But what stock to buy? How do I identify a company with strong fundamentals? One with great people who will make profits in the long run and in turn help me grow my wealth. Do I buy Tesla because that's what everyone is talking about? Or maybe Apple because I love Apple products? Or go with something more traditional like General Electric? Well, I'm going to make life very easy for you. Don't worry about picking the right stocks, just buy all of them. This is the simplest yet the most crucial part of making money in the stock market. The best minds in finance have done many studies on this for decades. They compare individual stock picking against the market. They compare actively managed mutual funds against the market. And what they consistently find is that the best way to make money in the stock market is to simply buy an index fund, a passively managed mutual fund that automatically buys appropriate ratios of every major stock in a given index. No guessing of what stock is better than the other. It just buys everything. One of the main reasons why index funds win in the long run is that it follows a predictable and automated set of rules when buying stocks. There is no highly paid fund manager trying to pick winning stocks for his or her latest actively managed mutual fund. On any given day, there are literally thousands and hundred thousands of people bickering over the correct value of each stock. One is saying this company is the next Apple. The next person is saying no, it's the next Enron. The truth is that some may be right, at some time, but a lot of them are wrong. And most are wrong in the long run. What's great about buying index funds is that it is essentially representing the average performance of all these bickering. No one can predict a company's performance and therefore the market's performance. Only thing we can predict is that our index will represent the market's average performance as a whole. So if we want to effectively make money in the market, we can by picking the index fund with the broad diversification and with the lowest fund. You might be asking at this point, all right, I hear you about index funds. But if that is right, how come the only thing I hear about when it comes to making money in the market are hot stocks and high-performing fund managers? The reason is identical to why places like Macau and Las Vegas continually thrive. Despite what data says about gambling or trying to pick winning stocks, we humans are irrational and emotional beings. We can't help ourselves or believe we're smarter than we actually are. Just ask my wife. In the world of investing, the surest way to win is to use statistics for our benefit, not against us. Therefore, when we buy the market average, aka index funds, we're increasing our probability of winning in the stock market versus trying to pick winning mutual funds or winning stocks. Alright, at this point you might be thinking, I get it. Don't think I'm smarter than the average and just buy the average. Buy index funds to make money in the market. But then, what specific index fund? Great question, and I have another very simple answer for you. My personal favorite and the king of all index funds, Vanguard Total Stock Market Index Fund, also most commonly known as VTSAX. With assets under management of $1.2 trillion, it is the most popular and the biggest index fund in the world. The fund aims to track the CRSP US Total Market Index. CRSP stands for Center for Research and Security Prices and is part of University of Chicago Booth School of Business. It probably is the most comprehensive total market index that includes around 4,000 companies across mega, large, small, and micro capitalization. And thus, at the time of this video, VTSAX represents about 4,100 publicly traded companies. It has an expense ratio of 0.04%, which means if you have $10,000 invested in VTSAX, you're essentially paying $4 for Vanguard to manage this fund for you. If you can believe it, actively managed funds and even some passively managed funds charge 10 to 20 times higher fees. VTSAX has a minimum investment requirement of $3,000. Though the original fund started in 1992, it's gone through some variations since, and as of the latest facelift in 2000, the fund's average annual total return has been 7.67%. If you want one fund to rule them all, this would be it. It not only represents big boy companies like Apple, Amazon, and Microsoft, it also represents thousands of lesser-known small ones as well. When you purchase VTSAX, you're essentially buying a piece of every one of these companies. Alright, now that I spent enough time talking to you about concepts and theories, let's actually see this strategy in action. Let's see if this strategy can actually double our money. Let's wind the clock back 10 years to year 2012. We're now recovering from the recession, and you have scrapped and patched together $10,000. You want to grow your money, but you want to do it confidently. Thankfully, you heard of this guy named Tay who has a great recommendation of investing in VTSAX. He looks a little funny, but he has amazing hair, so why not? I know this scenario doesn't make sense given this channel didn't exist in 2012, but bear with me in this one. In September of 2012, VTSAX was trading for about $35 a share. You open up an account with Vanguard and park your $10,000 in there. Now let's say life happened and you forgot about your investment. You got married, had kids, got a new job, and traveled around the world. It's now 2022, and as you're going through your finances, you remember that you made a $10,000 investment in VTSAX a decade ago. Given how the market's been doing the past year, you're hoping your $10,000 is still intact, or at least didn't lose too much of its value. How much do you think you'll have in your account? It's not $10,000, it's not $20,000, it's actually close to $28,000. As of this video, VTSAX is trading at around $97 a share. Your money not only doubled, but close to tripled in a period of 1 decade. Now, I want to highlight a few things here. This didn't just happen because of an accident. It happened because you as an investor followed some key principles. One is that you understood the market fundamentals, so you bought a low-cost index fund. However, the second principle is that you ignore all the noises of ups and downs. Now, in our example, this happened accidentally, but you get the point. A lot has happened in the past decade. COVID-19 struck the world and Russia invaded Ukraine. However, despite all that, the market went up in the long run. And this leads to the third key principle, patience. You held it long enough to reap the benefit of the market. Whenever major events happened, the market responded, most often with sharp declines. However, in the long run, it recovered. And that is why when you invest in the market with long-term mind, you'll not only double your money, but triple and even quadruple in the long run. Thank you guys for watching, and if you'd like to learn more about the effects of compounding, please check out my video here. Until next time, all the best.